The stock market has been flying. If you checked your portfolio today, you would have seen an absolute sea of green. The S&P 500 up by over 5%, the NASDAQ up by over 7% in a single session. Apple today actually set the single largest recorded gain in US market history, with adding over $190 billion in just the one session. Of course, all of these gains, the records going tumbling, it centers around one single US CPI inflation print. If you're wondering why this has happened, today we're going to unpack it all, and we'll talk about what it means for the broader macroeconomic picture. But first, let's talk about the inflation print. As we know, the inflation narrative has been front and center over the past period. Today was actually the single largest day after a post-CPI print. Of course, initially, as inflation was more persistent than initially thought, we saw interest rates rising from a near zero rate. Obviously, as interest rates rise, the discount rates rise as well. And the story initially surrounded valuations, particularly for those longer duration assets. However, as inflation has stayed more persistent than initially thought, the question has now moved really towards what will the Federal Reserve and other central banks have to do to curtail inflation? Obviously, the higher inflation stays, the more interest rates will have to rise. But the question is, what happens if they hike too far? Obviously, interest rates rising will curtail consumer demand, but it's also going to inhibit the economic growth and the robust recovery that we saw out of the virus and the lockdowns. And so, yesterday, the CPI inflation print came through. Consensus was for 7.9%, down from 8.2% the month before. We actually saw a 7.7%, which means it was a downside beat. It surprised. It was a miss to the downside that was definitely appreciated by the markets. And really, there were a few different contributing factors as to why we saw this face-ripping rally across the equity markets. As we know, coming into this print, we've had 4 jumbo-sized rate hikes from the Federal Reserve. Other central banks have been following in a similar suit, but the Fed have been extremely hawkish, 75 basis points in a row. So the question really was, what's going to happen in December? Will it be more of the same? Will they potentially get some runway that maybe they can take their foot slightly off the gas? Though, of course, it's not like the hiking cycle is going to be over. In terms of the short term, there is a few interesting dynamics. Obviously, short-term oversold on the technicals. There's been discussions about the short interest as well. But on the other side, we think about how we came into this past period. There's been mayhem in the crypto market with everything happening with FTX and Binance. Obviously, more uncertainty than was anticipated in the midterm elections. And so it seemed like the stage was set for what was going to be a very keenly watched CPI inflation print. And with this print now, it's anticipated that the Federal Reserve has a little bit more leeway. Obviously, heading into December, it's still a toss-up between the 50, 75 basis points. Consensus slightly shifting towards 50, though 75 basis points is probably still that base case there. But it does mean that the Federal Reserve have the ability to potentially consider a pivot from ultra-hawkishness towards something slightly more dovish. Though, of course, as we mentioned, this is not the end of the rate hike cycle. It's more a transition in terms of perhaps the worst of it is behind us, and maybe we can move into more of a steady state. It's also worth understanding as well the contextual backdrop that this 7.7% year-on-year inflation print is the lowest it's been since January. Now, why is January 2022 important? Well, that period was before the Ukrainian situation. Obviously, as the Ukrainian situation occurred, we saw the supply chains come under pressure, commodities prices rising higher, and this all fed into the elevated inflation print. But the fact that we've got below that level is a key psychological level as well, and it's been keenly watched by economists. It truly was a face-ripping rally. On one side of the story, we know the S&P 500 is still down year to date by 17%, the NASDAQ nearly 30% off the peaks there. However, on the other side, we saw the S&P, the Dow, and the NASDAQ all soar through key technical levels and close above them. Let us know your thoughts. Drop in a comment below. Is this a bounce before we go lower, or is the worst of it behind us? Here's another video you can check out talking about the number one lithium stock, particularly with the interest after the EV revolution. But the question still remains. What will the Federal Reserve do in December? Is inflation now starting on its trajectory down, or is this an atypical period? The markets are always interesting. A big thank you for joining us. For now, stay well and happy investing.